Hey everyone, and welcome to the first episode of Stardust Crypto News Roundup. We're your hosts, Adit and Teresa, and today we're going to break down EIP1559, a part of the London hard fork that just went live on August 5th and to date has already burned over 23,000 Ether in just 5 days. We're going to explain all of that and more, but to do that, we're going to have to rewind just a little bit and go down to the block level because that's where this whole party starts. Pre-EIP1559, basically just a week ago, let's look at how those blocks were made. To start with the basics, every 15 seconds, a block is mined through proof of work. Now, during those 15 seconds, you've got all of these transactions across the entire network that are trying to get mined in the next block. To paint this picture, let's say Adit lost a bet, and he's got to pay me 1 Ether. So this would be a simple ledger entry. The transaction complexity is on the lower end, and it's fixed to 21,000 gas. But what is gas? Well, it's how the Ethereum blockchain quantifies complexity. So let's say at the same time, some guy named Bob buys a CryptoPunk NFT on OpenSea. Now there's a lot more going on in this transaction as it's not just a simple ledger entry, it's a smart contract. It's much more complex to resolve and therefore is going to require more gas. Now the amount varies depending on the contract, but let's just say that this one is really complicated and is going to require almost 15 million gas. So as we said before, there's a fixed size to every block, and that size prior to EIP 1559 was limited to 15 million gas exactly. So you've got all these transactions going on simultaneously across the globe, trying to get onto the next block on Ethereum's chain, but there's a cutoff. So how do you determine who gets on and then who's got to wait in line for the next block? Well, sticking with the prior to 1559 timeframe, it was like an auction system. You would basically bid on how much you thought the transaction fee would be. Bids are usually measured in units of gwei, and a gwei is a billionth of an ETH. So in our previous example, let's say Adit bid 10 gwei, then Bob bid 5, and Rachel bid 1, and so her transaction to pay Jen is not going to be included, as the miners include the highest bids first. So note that even though Adit and Bob only had to pay 2 gwei to beat Rachel, the amount that they overbid isn't refunded. It still goes to the miner. Before EIP 1559, all of these transaction fees, which are calculated as the gas used times the bidded gas price, would get added to a fixed reward of 2 ETH that would go straight to the miners. You can probably see a few problems with this model, particularly around the lack of transparency and predictability of gas prices.
Enter EIP 1559. With Ethereum ultimately aiming to move to a proof-of-stake blockchain with the Ethereum 2.0 update, there was an opportunity to change the logic behind how blocks are created in the interim stage. We're going to cover the 4 biggest changes the protocol makes. The first is changing the block size. The second is revamping the old auction system. Third is the refund system for overbidding. And the last one, and the one you've probably heard the most about, is the burning of Ether tokens. Let's start with the doubling of the block size. While the system still targets its original 15 million gas as a moving target, there's now an additional 15 million reserve capacity to help deal with network congestion and high demand. So in our case, Rachel's payment would have most likely gone through by taking advantage of this additional space. Change number 2 is revamping of the auction system. Historically, you'd have to have known about gas or have used a website or a tool to trade off the cost versus execution time. With EIP 1559, this bid is now split into 2 components. There's a base fee and a priority fee. This base fee is now handled by the Ethereum blockchain algorithmically. The network can move the base price up or down a max of 12.5% from block to block in an attempt to make fees more predictable. Ultimately though, it doesn't solve the core problem of high fees or spikes, as the prices can still 10x in just 5 minutes. In fact, here you can see the base price tripling over the course of just a few blocks. If it's a really important contract that needs to be settled immediately, or a high priority transaction, you can put in a priority fee to move it to the front of the line to have it executed quickly. With EIP 1559, the extra bid amount over what was necessary to get into the block is actually refunded back to the user. This is unlike the old auction system where what you bid is what you paid. Undoubtedly though, the biggest change is that all of the fees that go into the base fee get destroyed and are eliminated completely from the ledger. Here's a block mined after EIP 1559 with the base fee, priority fee, and fixed rewards all split out. Users collectively are still paying 1.9 Ether in fees, but the base fee was burned. Those tokens were destroyed and completely eliminated from the blockchain. The priority fees and the newly minted tokens still go to the miner, but the miners lost out on that base fee that they otherwise would have collected prior to the implementation of EIP1559. You might have heard people saying Ether is now deflationary because it's burning coins. Here, we're looking at the supply of Ether since EIP1559 was implemented. Coins started being burned on August 5th, and we can see that while 20,000 coins have been burned, that's significantly less than the new supply from fixed rewards. As of now, Ethereum is not really deflationary and continues to increase in supply by about 9,000 Ether a day. But if there are changes to that fixed reward, it has the potential to become really deflationary. So what does this all mean for you? Well, if you transact a lot on the Ethereum network, the more predictable base fees, flexible blocks with the capacity to double, and the refunds of overbids are clearly welcome additions. But if you're a miner, well, you've taken quite a hit to your revenue and are now much more reliant on the fixed 2 Ether reward than you were before. Ultimately though, what EIP 1559 really is a preparatory step for the move to proof of stake. It's not addressing the core issues of scalability and high vague transaction fees. We're still seeing spikes in the network and are likely to continue to see them. Instead, it's a step toward the Ethereum 2.0 upgrade. It's laying the groundwork for the targeted release that's in late 2021 or early 2022.
Thanks so much for joining, y'all. Let us know what you think of EIP 1559 in the comments below, and if you think it's a win for the community and a step in the right direction. We'll be back later this week to break down Coinbase's second quarter earnings report, and we will definitely be talking about the latest in crypto legislation, so hit that notification bell if you don't want to miss out. Until then, see you all later.